In the previous video, we discussed about industry, infrastructure, and services. Today, we're going to start with the Indian economy, external sector, balance of payments, trade, and investment. So, when starting with balance of payments, first let's understand what is balance of payments. When we think about economy of a nation, we are concerned about how much country and country residents they are earning and how much money is going out of the country. So for that we require balance of payments, double entry bookkeeping. So all the inflows and all the outflows are recorded in there. And as we prepare the balance sheet, in the end there will be no uh, the debit side and credit side. That means all the inflows and outflows. You get to understand that which one is more, which one is less, and what they're saying is that entries must in theory always be zero. So in the end, it will be because you have to take all the balances carried forward, and that's why the final total on both the sides are equal. So there's no there's zero balance account. That's what we say. Okay. Now components of current account versus capital account. So we have understood that balance of payment is all about inflows and outflows. So two words you have to remember here is that it's all about inflows and outflows, a systematic statement of economic and financial transactions between a country, residents and the rest of the world, non-residents. जो देश में रह रहे हैं और जो देश से बाहर हैं उनके बीच में स्पेसिफिक पीरियड में इकोनॉमिक एक्टिविटी और फाइनेंशियल ट्रांजैक्शंस जो भी हुए हैं वो हमारे बैलेंस ऑफ पेमेंट्स में आएंगे. डबल एंट्री बुक कीपिंग अकाउंटेंसी में हमेशा हम डबल एंट्री बुक कीपिंग करते हैं मतलब कि हर एंट्री का दो तरफ दो जगह पे उसकी एक पर्टिकुलर ट्रांजैक्शन की रिकॉर्डिंग दो जगह पे होती है. That's what double entry bookkeeping is all about. Meaning the sum of all credit inflows and debit outflows entries in theory always be zero. So they are not saying that ये हमेशा equal होंगे. ये कभी नहीं बोल रहे. इसका सिर्फ इतना कहने का मतलब है कि क्योंकि हम बैलेंस कैरी फॉरवर्ड करते हैं इस वजह से वो एन अकाउंटेंसी स्टेटमेंट एंड में इक्वल हो जाती है दोनों साइड्स. Okay, let's move further. So current account versus capital account. Now it's a major part of component of balance of payments. So what's current account? That measures net income. Now, transactions in current account which will be taken into consideration will be trade in goods, services, income transfers, and components are trade in goods. That means merchandise exports or imports, things which we are exporting or importing. That's part of trade in goods, and trade in services is like travel, transfer, software. Primary income, investment income, that is interest, dividends, and profit. And secondary income, fund transfer, remittances, gifts, and grants. Now, current account deficit. Deficit means outflows are more than inflows. That means deficit. Then comes to capital account, measures net change in assets or liabilities. Assets we understand, anything of value, liabilities we understand, that we are liable to pay. Now, stock transactions, investments, loans, bank capital, all are the major transactions happening here. And the components are foreign investment, that is FDI, foreign direct investment, and FCPs, foreign currency payables. ECPs are there, external commercial borrowings, and FPI, foreign portfolio investment is there. Also, As we discussed, external commercial borrowings uh, and foreign aid and trade credit, these all are the major components, and NRI deposits, that's also a major component. Then comes capital account surplus. Again, inflows are more than outflows. That's generally desirable for developing nations. That's correct. Now let's understand deficits and surpluses. Balance of trade only measures the difference between exports and imports of goods visibles. India usually has a BOT deficit. That means we are importing more and we are exporting less. Next is current account deficit. Occurs when the value of a country's imports of goods, services, and transfers is greater than its exports. So imports are more than exports. Our current account deficit must be financed by capital account surplus, inflows of foreign investments or loans, or by drawing down foreign exchange reserves. A small CAT example would provide 2.5% of GDP for a developing nation like India is often considered manageable as imports include productive capital goods. BoP equilibrium. Now, balance of payment equilibrium. In practice, if the overall balance of payment is in deficit, which means the central bank has to sell foreign currency, draw down reserves to balance the books. Next comes foreign exchange reserves. Forex. The Forex reserve assets held by the Reserve Bank of India, providing a buffer against external shocks and managing the exchange rate. Now, let's look at the composition of foreign exchange reserves. Foreign currency assets, largest component held in multi-currency assets, example US dollar, euro, pound sterling. Gold held by the RBI, special drawing rights, an international reserve asset created by the International Monetary Fund. Reserve transposition in the IMF, part of a country's quota in the IMF. Importance provides confidence to international investors, helps cover the import bill for a certain number of months, enables the RBI to intervene in the foreign exchange market, buy sell currency to manage volatility. Trends. India's reserves have generally been on an increasing trend, providing a strong external buffer. Next is exchange rate regimes. Regime is fixed, pegged. Description: the government or central bank fixes the exchange rate against another currency or gold and intervenes to maintain it. India's regime not used now, so floating the exchange rate is determined purely by the market force of demand and supply. India's regime not fully adopted in floating. Managed float. The exchange rate is mainly market determined, but the central bank (RBI) intervene occasionally to curb excessive volatility. Currently followed by India. So, if we look at exchange rate regimes, the fixed one, floating one, managed float. There are three kinds of regime. First one, fixed one exchange rate regime is the government or central bank fixes the exchange rate against another currency or gold and intervenes to maintain it. Floating the exchange rate is determined purely by the market forces of demand and supply. So, India is majorly dealing in floating regime and managed float. Okay, so we are not into fixed regime, we're into floating or managed float. Now, understand managed float currently, which is being followed mostly in India. Exchange rate is mainly market determined, but the central bank intervenes occasionally to curb excessive volatility. Now, this is what is being followed by India, okay, mostly. So this is our managed float or regime. Understood. Now, impact of rupee depreciation on appreciation. Now, depreciation rupee weakens. Example, exports become cheaper for foreigners, boost exports, positive for exporters. Imports become costlier in rupee terms and discourages imports, negative for importers. Inflation, higher cost of imports, especially crude oil, commodities, leads to imported inflation, negative. Debt, servicing of foreign debt, ECBs becomes costlier, negative. CD tends to improve, narrow the trade balance over time. J curve effect. Now, J curve effect we have not covered so far, so we are not doing it. In case we get any question, we'll be looking at the questions accordingly, and then we will study about the J curve effect as well. Now, appreciation of rupee strengthens. Opposite effects. Exports become costlier, imports become cheaper. Next comes capital account convertibility. Now, convertibility is capital account convertibility is freedom to convert the domestic currency to foreign currency and vice versa. Current account convertibility full. India already has full convertibility for current account transactions. Example, trade, remittances, foreign travel. Capital account convertibility, which is partial. Residents face restrictions on certain capital account transactions. Example, individuals cannot freely purchase property abroad. Tarapur Committee 97-2006, 97 and 2006 recommended a phased roadmap towards full current account convertibility, but with preconditions. So, low CAD, strong forex reserves, and low inflation, sound financial system to manage risks like capital flight. So, so far this much. Thank you.